I think we finish our kind of third piece of this market and the development of this market with Faryar Shirzad from Coinbase. He's the Chief Policy Officer at Coinbase, and it's a real pleasure having you with us. I don't know how much opportunity you had to listen to both Alex and Mike, but we've already talked about the pros and cons of the crypto winter and what we can learn from the quote-unquote demise of the crypto market, or what we could learn about the new investment strategies for the new crypto market. So it was a very mixed, ultimately very positive interpretation that we're kind of evolving, that the industry is evolving, that the market is evolving. And that's exactly what I would love to explore with you, is obviously if you look into the market today, it's maybe not the very best, although it's picked up a little bit again in recent weeks. But I would like to kind of just get to kick us off, your perception on the last 12, 18 months, how you see the evolution of the crypto market.
Thank you, Nick. I appreciate the opportunity to join you. I had a chance to listen to most of what Michael was saying, which I always enjoy. And I particularly enjoy it because he lives 2 doors down from me. So I almost could hear his voice through my window as he was speaking, even before I had the video on. But, you know, Nick, the past year has been quite, it's a understatement to say that it's been a volatile and complicated year. But I would say it's also been, for most of us and for companies like Coinbase that have been around for a long time, a healthy cleansing and a disciplining period, in the sense that you had a few things happen. One is we learned a lot about the behavior of crypto in a broader macro downturn. And you saw that there was a much greater correlation between crypto assets and traditional financial markets that we saw over the course of the last year. I mean, there are different estimates that people have put out, but I think you could say on the order of about 2/3, maybe more, of the downturn in crypto has been correlated with and is attributable to the broader macro downturn, dynamics that we're facing. There's an additional portion that may be crypto specific, which I don't think is a surprise given the heavy retail orientation of the market at the moment, and the fact that you had, it's a new space with new adoption, and so you had people sort of slow down in terms of their activity. So we learned a lot about the correlation of crypto with broader market dynamics, but we also saw as a cleansing of a lot of bad actors out of the crypto space. I think what we all learned is what, those of us at Coinbase have long understood, that the principles of governance, risk management, and frankly, good practices ultimately are important in crypto, just like they are in any other sector. And so for intermediated crypto activity, where you have somebody like a Coinbase or somebody sitting, custodying customer funds, intermediating the customer's experience with the crypto markets, it's critical for those intermediaries to operate under basic principles of effective risk management and governance, and not engage in fraud and what have you. And that's as true in crypto as it is in any other sector. So it was a reminder that the financial markets periodically have to have, and crypto has not needed to have, which was for all the people who came in and thought the laws of gravity don't apply to crypto. I think they learned a lesson. And I think for those of us who've been building for the long term, it's probably healthy to see that lesson get transmitted through the sector, and for people who are serious about building to remain in, and those who just came in for, the opportunistically get washed out. And so I think for those of us who, are committed to the space, I think we feel like it's been, it's been a healthy dynamic. And then I think what we've also seen is that the technology has proven itself to be extraordinarily resilient. The tokens have performed well. Smart contracts have performed well. Stable coins that are actually backed by reserve assets have seen increased adoption. And so all of that has been a period of validation and vindication of the resilience of the technology through an extraordinarily stressful period. And so when people puzzle about whether crypto, could withstand some sort of stress test, we've seen that stress test over the course of the last year, and the technology has proven extraordinarily resilient. But of course, the bad actors that we've seen have also kind of been shown up as the tide went out. And so I think all in all, we feel pretty good about where we are. But why don't I leave it at that, and we can kind of go to the next question.
No, I think it's interesting because I think the trend we're seeing is a trend you see often in the adoption of new technologies. You go through a few kind of cycles before there's a kind of comfort of adoption in an industry. And it's interesting the way you describe it. The developments of the last 18 months is a reflection of that. But to what extent does FTX fit into this? I think it does to a certain extent. You made the point about risk management and so on. But FTX, in a way, took it a step further, I would say, because it was a debate about the underlying infrastructure. It wasn't so much about the actual tokens. It was more about an institution that was close to becoming a clearing and settlement infrastructure, supervised, seen as the big new future in moving cryptos into the mainstream financial services industry. So how do you see the events around FTX in November last year as another add-on, so to speak, to the volatility in the market?
Oh, it was a huge contributor to the volatility. Clearly, the shock of the FTX collapse reverberated through the markets. We saw it in market volume shift. Now, for us, we saw some benefits from it because some of that volume shifted to our platform. But nonetheless, in terms of the macro implications of FTX on markets and pricing, the impact was real and measurable. But I think the lessons of it were pretty obvious. Were the ones that I said, which is we need to have effective regulatory oversight of crypto intermediaries. And so if you have an FTX or what have you, it's critical that the regulators who oversee that activity have the regulatory authority as well as the supervisory capacity to engage in the necessary oversight. And that's why those of us in the industry who've been active in the policy space have been essentially delivering that same message for the last 18 months I've been in the sector, but others have even longer, which is it's critical to have regulators who have clear rules that work for the differences in crypto relative to traditional markets, but also the sophistication and the staffing necessary to provide effective oversight. There's a symbiosis between effective development of the intermediated crypto markets and good regulatory and supervisory practices. Those two things go hand in hand, and we welcome that. I do think, without getting too complicated about it, crypto's a lot of things, right? So there's intermediated crypto activity. So, for example, FTX taking people's funds and misusing it, or companies like ourselves and others who operate at high standards, doing that job effectively. But whenever you have people, individuals or an entity in the middle taking people's money and managing their funds or their assets, there has to be effective regulation around it. But crypto is also a very empowering technology. Michael alluded to this in the previous conversation. So there's an ability of people to be able to operate with much more autonomy and much more empowerment than they can under the traditional financial system. So there's a balance to be struck to make sure that intermediated crypto is subject to rigorous oversight, but that there's a zone of autonomy and freedom that individuals have to be able to take the empowerment that crypto provides and be able to transact in ways that that are kind of consistent with their personal freedom. And that balance is something policymakers are thinking through, and those of us in the industry are trying to contribute to.
I'd like to draw on two themes that you've mentioned there. One is, as you say, industry standards. And obviously one thing we saw emerge very quickly is a request for proof of reserves. The auditors poured in to deal with this. I'd be interested to hear a bit more what Coinbase did do itself to reinforce its standards, or to demonstrate the standards it had in place to make that maybe more transparent, or communicate this to the market. And the other one, you made the point about regulation. And we had many conversations already about MiCA. It was mentioned, although we spent more time in the panel in the moment on MiCA. But everybody concluded MiCA would not have solved FTX. So I'd be interested to hear how you view the MiCA framework from a Coinbase perspective?
Well, on the reserves issue, it's a really important question. We actually did a really effective blog post on this issue that people may want to read. Now, for us, it was a simple question in terms of reassuring the markets about our balance sheet, because we're a public company. We're the only publicly traded crypto exchange, so publicly listed, publicly traded on NASDAQ. And so we have a third-party auditor, Deloitte, that does audited financials. They're published for anyone to see. They're quite sophisticated in knowing our operations and our business. They've been with us for quite some time, and so they produce audited financials that give the markets and investors, analysts, what have you, the confidence they need to understand kind of what our asset and liability mix looks like. I think the harder thing is how to and I think this is a really critical exercise, is how to develop a crypto solution to disclosure of the full balance sheet of crypto market participants. So publishing proof of reserves is important, but it doesn't necessarily capture the liability side of the balance sheet. There are ways you can do a proof of reserves and liabilities disclosure on chain, but it doesn't necessarily pick up off-chain exposures and liabilities that investors and analysts would need to know. So we've actually put some money forward to fund developers that may have ideas on how to create an on-chain solution to provide transparency regarding the balance sheet of a crypto company using on-chain technologies, crypto native on-chain technologies. I don't think we're quite there yet, but I think for companies that are issuing proof of reserve attestations and proof of reserves and liabilities, I think that's a step forward. In terms of the second question, we feel quite good about MiCA. I think MiCA, is obviously two parts. One is the regulation of VASPs, the virtual asset service providers, so companies like Coinbase and others. And then the second part has to do with stablecoins. I think in general, I think the VASP rules are quite well done. I think they recognize in MiCA the differences between traditional financial services and token-based or crypto asset-based services, and so creating a new regulatory regime around crypto asset service providers or virtual asset service providers, I think is healthy. I think as the supervisory capabilities of national regulators develops, I do think it's hard to see how a FTX type fraud could persist, but I think it's hard to ultimately prove the counterfactual. But I think they will provide for significant consumer protections and market assurance regarding the operation of the crypto markets once you have MiCA fully into effect. In terms of the stablecoin side of MiCA, I think it's quite good. I think there's certain capital charges that seem disproportionate for those of us who understand the space, because in the end, stablecoin issuance is much less complicated. It's actually quite a vanilla activity relative to fractional reserve banking. So to impose quite severe capital charges against the reserves that are being held one for one against stablecoins that may be issued in Europe, far beyond any kind of underlying risk, is significantly out of proportion. I think many European policymakers understand this, but we'll have to see whether there's an ability for a stablecoin, a European EU-based euro-denominated stablecoin market to emerge. I think it would be healthy for it to happen. It would be a healthy complement to a euro CBDC, and we're very hopeful that as the level 2 work gets done, that could be ultimately done in a way that will allow the stablecoin market to develop in the EU.
We had Dante from Circle speak this morning about this specifically, but I personally would fully agree with you that the rules are deliberately politically prohibitive around stablecoins, and that was grown out of a unique historical circumstance that we all know, which went back to Libra and Diem. We have to see. I'm less optimistic level 2 can solve the problem, but I think people are becoming aware about the potential of stable coins in the context outside that particular unique historical moment. And that brings me maybe to the next question, the one but last question, which is kind of looking forward. Obviously, you remain optimistic, very optimistic, not just about the use of stable coins and crypto assets, but also its potential in transforming existing financial markets, providing technological solutions to the market. In a way, it's a race between different players to occupy some of that infrastructure, that future financial infrastructure. How do you see the potential evolve?
Crypto is, in a way, crypto was introduced to the world through Satoshi Nakamoto's white paper as a financial innovation. And I think it made sense because it was at its most fundamental level, the ability to transmit value in digital form. And that's a profoundly important historical innovative step. And so one naturally, as Satoshi presented, would think about the transmission of value as the transmission of a financial asset. And so we have found ourselves that the debate around crypto naturally has revolved around the tolerances and the perspectives of financial regulators. Again, very natural, very understandable. The problem with that is that there are a whole host of social applications being developed around the crypto technology. So Michael mentioned, the tokenization of a variety of different things, but you can tokenize things like your own identity, your social affiliations, your political interests. There's a range of things that we will ultimately be able to represent our affinity to and participation in tokenized form. And we will store that information, including most preciously our identity, in tokenized form in self-hosted wallets that we will use to, in a much more empowered way, navigate the digital world. Right now, we rely on intermediaries to vouch for us that we are who we say we are, that we own the funds and assets that we say we own, that we have affiliation with this or that, that our interests are of a certain kind. When you're able to tokenize that information and hold it and be able to be the one that decides how it's transmitted, because you don't need to have anybody else validate that for you. That's a very powerful thing, but it's as important a social innovation as it is a financial innovation. So I'm saying this to say that one of my worries is that you have a financial lens and a financial regulatory lens being applied to crypto, in particular the use of self-hosted wallets, that suggests that all these wallets do is to store financial assets. And I think that's something that as the pace of innovation picks up, I'm hopeful it will pick up in a way where society generally and policymakers for sure begin to understand that how we regulate these wallets has to be done in a way that's consistent with some of the principles in GDPR or other privacy regulations, where there's a degree to which the people have some right to be able to control their information free from surveillance from third parties, large tech intermediaries, and also under appropriate guardrails from the government. And I think we need to kind of begin to widen that aperture quickly, particularly as there's really interesting innovations being developed around digitizing identity and so on. So it's an abstract concept, but it'll become less abstract as use cases develop. And I think we just need to make sure that the regulations don't impede that innovation, because we see it as purely a financial mechanism.
I think I'm happy you make that link between privacy and tokenization, because tokenization is there to depersonalize some of that information in the transmission and only have that data used where it is needed, so to speak, when the letter arrives on the other side and the recipient opens that letter. And I think that gets often lost in the GDPR debate in Europe. And with that, setting out this rather positive vision an interesting vision. Where do you see some of the main barriers to such a vision being realized at the moment? What are some of the public policy impediments? You already mentioned self-hosted wallets. There's a fairly dynamic debate going on around the treatment of that within the anti-money laundering context. But are there other kind of examples where you feel there are unnecessary impediments set by the regulatory framework to the evolution of a more autonomous driven environment?
Yeah, I think there are two really. One is the one I mentioned, which is assuming that the wallet, what we call a self-hosted wallet, which is probably a bad, is a bad way to, bad terminology, but assuming that it's purely a financial mechanism. As you said, and I said, we will be tokenizing our IDs so that we're not in a position where when we have to prove that we're of age, for example, let's say we have to demonstrate that we're an adult, for example, or over 21 or whatever the requirement may be for a certain thing, we don't have to hand over our entire kind of biometric and biographical information to a merchant, for example, or a social media platform to be able to participate. We can simply be able to demonstrate in tokenized form that we are, eligible based on the criteria established. And I think the ability to be able to do that is important. But if the wallet is ultimately subject to surveillance by the government for financial reasons, all the things that you'd be able to tokenize, including your political affiliation, your religious affiliations, your social affiliations, your interest in art or what have you, all of that becomes subject to surveillance by the state in a way that we would never countenance in the traditional system. There's and that is a principle that people haven't fully gotten their arms around, and I think, as we both said, I think needs to be understood quickly, because the rules, like in the AML context, are assuming it's only a financial instrument, and the outcome could be quite damaging for individual autonomy and individual privacy. I think the second thing is that and you'll see it in some markets, where there's a view where people like the blockchain, but they don't like tokens. They like a certain type of curated market, but don't like retail participation. And I think people, particularly at this early stage of the development of the markets, there's an integrated ecosystem in crypto between the retail markets, the very, very rapidly developing institutional markets, and then also the intermediated activity versus the more autonomously driven activity. That ecosystem needs to be allowed to flourish, obviously under appropriate guardrails. And I worry at times that we see in some jurisdictions they'll decide, well, we like this type of activity, we don't like that type. We like the blockchain, but we don't like the tokens, because we perceive the tokens to be purely a speculative thing. And I think that's a dangerous misunderstanding of how integrated this ecosystem is. And I think that's the second kind of big area of concern that we have.
Thank you very much.
Nick, I know we're short on time.
Please do.
We often talk about Web3, and I think it might make sense to explain what that is. The first generation of the internet, what people call Web 1, was the ability to go online and read data that others have put on. But as an individual user, there was no capacity for you to put information onto the internet. You could simply, as an individual, go in and read the data. Web 2, which is largely the model we have now, allows you to go on the internet not only to read information, but also to post information. And that's how social media, Facebook, and a lot of other sort of innovations have developed, where you can not only read, but you can also write. And that's the model that we're largely accustomed to, and why the social media explosion occurred. The third version that we will talk about, Web 3, is the ability to read, write, and then to own. The fact that you can digitally tokenize your ownership interest in, an asset, your property, your fishing license, your political affiliation, your identity, is what we talk about when we talk about Web 3. There's an ability to not only go on the internet, where so much of our social lives, educational lives, work lives, and personal lives are being transacted, and not just read and write, but also own an ability to own your own information and decide the terms under which it's transmitted. And that's a very powerful thing that goes far beyond financial services that we need to cherish, that we have this opportunity to develop this more empowered digital space, but also make sure the public policy doesn't impede its development. And I think that's why sessions like this that you're organizing are so important for people to understand the stakes, what's at stake in front of us.
No, thank you, Faryar, for that point. And yesterday we had a session specifically on Web3 and the metaverse. And I think it complements very nicely what you said, because there it was all about the non-financial application. And you're making the point, there is a financial application, but there's also the non-financial one. And I think where to draw the line, not everything that's on the metaverse is financial services just because it's tokenized. I think it's important you made that point. Faryar, thank you so much for being with us. And yes, it is a pleasure to organize these events, because I think it is about education and understanding how the market is evolving and what public policy challenges there are and how to maneuver one's way through them. Thank you very much. And I think you've teed up a patiently waiting panel who will discuss the whole crypto universe in much more detail. Thanks for being with us, Faryar.